All right, good afternoon. It is Tuesday, June 14th, 2022. It is just afternoon in New York. Um, Today we are on the eve of the FOMC interest rate meeting announcement tomorrow. So we're seeing just choppy price action today. I don't think a lot of people, I don't think a lot of professional traders are doing much today. A lot of people are just sitting tight as there's a lot of uncertainty, especially with that CPI report that came out on Friday. Not only that CPI report, but on Thursday we had. Let me pull up my charts here. We had the ECB meeting that happened, and I just was able to review some of the data. Some of the data is lagging, right? And so that happened on Thursday morning, and so right now it's the third day since that ECB meeting. Usually the data will turn before a big movement like this. Okay, just like you can look at our past videos and see where the data turned here. We were able to swing long here, but this one was really sudden. It caught a lot of people off guard. A lot of professional traders were caught off guard on this. Um, and we're noticing some liquidation here. We saw a little bit of a rally here. I suspect that this morning there were probably some margin calls, probably a lot of leverage longs. They, inevitably, if something like this happens, you're gonna have some people, some traders who just keep who don't put stops in, and they just hold, hoping that it reverses. Well, if it doesn't, the broker is forced to liquidate. Liquidate means just do the opposite transaction. So if leverage longs are insolvent, liquidation would mean liquidation would mean closing it out, selling. So I suspect that a lot of that liquidation, it could have happened around here yesterday, and maybe this was a little bit of you know, just a little bit of a reaction to that. Since everybody has sold, maybe there was a little bit of a seller exhaustion maybe this morning, and then it just continues, right? This is what happens when liquidity is low, all right? And it just keeps no matter what, no matter what happens, even if there's a little bit of short covering, it just really doesn't matter. It's just going to keep going down. That's what I suggest. That's what I think. I think, probably a lot of people got liquidated here or so this morning from their longs here. So we'll see. We'll see what happens. Okay. So one of our members asked about the FOMC, the chances of rate hike that the CME publishes. So we'll go over that too. Since that's kind of the main thing on people's mind right now, I have it here. So, based on, the Fed futures, the Fed funds futures, CME publishes these target rate probabilities. All right. And so, there's speculators, there's institutions, there's commercial hedgers who are out there that they basically they place bets on these Fed funds futures, and based on the pricing of those futures, we can see what the market expects the Fed to do. Okay, so that's all this is. This is just based off of the Fed funds futures trading, and based on those prices, this is what the market thinks the probability of 3 rate hikes versus 2 rate hikes. All right. As you can see, until a week ago, basically up until before the ECB meeting, and up until up until the CPI report as well, most traders and institutions were expecting 2 rate hikes. And in the last 3 sessions or so, that has diminished greatly. Now, everybody, most institutions and traders are now expecting 3 rate hikes for tomorrow. So that's why we probably saw this risk off sentiment. The bond market really just moved really quickly after that CPI report. It just and actually it started with the ECB meeting. After the ECB meeting, it fell, and we saw the probabilities change about 10 percentage points, 10 to 20 if I recall correctly. And then after the CPI, I mean it just continued. It just cascaded. All right. This was really fast. It's very, happening this quickly was very low probability. We had those calendar diagonal spreads. And remember, I told you on that, going below 380 by this, by before FOMC was going to be a greater than 1 standard deviation move, which means, out of all the distribution of occurrences, it's unlikely. There's 68.2% of the times it was going to stay above that 380, but it didn't. It just went right through. So that's the type of move. It was a very low probability move, but it happened. Sometimes that 20-30% move happens. And that's why, you have to keep your position small. You have to manage your risk. All right. Those who didn't manage risk definitely paid for it. All right. So again, no matter how right you think you are, no matter what the probability of your trade is, it could be 70, 80, 90%. That 10% chance could be that 10% move could be the one that wipes you out, that low probability move. So again, no matter what story you tell yourself, you really have to manage risk. And I can't stress that enough. Yesterday's video was mostly about risk management. I highly recommend you all look into that video. And we'll have more discussions around risk management later on. Okay, so hopefully that explanation helps with what the probabilities and how those probabilities are determined by the CME. You don't really have to understand the methodologies and the calculations per se. Just have that website handy, and they already do it for you. So there's that. Now, one thing I also wanted to go over was the Repo facility. We've been having some interesting action, and also, one of our members pointed out that there was a record reverse repo transactions here that was posted yesterday by Bloomberg. That's huge. So here's what a reverse repo facility is. So the Federal Reserve, in order to keep short-term interest rates stable and to really control that short-term liquidity, they offer this reverse repo, and it's short for reverse repurchase agreement. Okay, so it's a reverse repo facility. Basically, institutions, brokerages, sovereign wealth funds, what they can do is go to the Fed, all right, give them cash, and the Fed will give them a security that promises them that they will give them back the cash plus, or repurchase basically that security for cash, for the amount that they paid for it, plus interest. So if I were some brokerage and I had some excess cash, I could go to the Fed window, all right, take however much excess cash I have, leave it with the Fed. The Fed gives me a security. They promise to repurchase back my security plus interest, and that is a way to make some risk-free money, almost like you and I would go to like a money market or something. It's basically it's a money market alternative, all right, for institutions. All right. So generally, when this is going up, all right, generally that means that it's taking bank deposits. All right. So basically bank deposits are going into here rather than staying at the bank. All right. Now, what is the significance of that? Well, here's the thing. So we're going through quantitative tightening right now. The Fed has already started reducing its balance sheet. They're raising interest rates. And not only that, now bank deposits are leaving banks and they're still coming to this. Now, the expectation was that as interest rates go up, more people are going to go over to treasury bills, okay, as the interest rates are higher and they're more favorable. But as we can see, people are still piling on into the reverse repo facility, okay, because there's an imbalance in the treasury bill market. So they're going into repos, and bank deposits are going down. So this is, basically, this is what I think, all right? Probably in about 6 to 9 months, banks are going to have to fight for deposits, all right? Maybe not all banks. I think the big institutions like JP Morgan, Goldman Sachs, and all that, I think they have excess reserves. They probably are welcoming this. When big institutions, when big money centers like JP Morgan, when they have excess, when they have too much cash on deposits, it hurts their return on equity. All right. But most banks are probably going to have to fight for deposits. And when that happens, they have to raise their deposit rates. Well, when they raise their deposit rates, how are they going to make up that money, right? They're going to have to raise interest rates on the loans, on what their clients borrow. All right, they're going to have to raise those rates. So that's an additional tightening that the market will have to face. So not only from the Fed, but also from the actual banking system itself, there's going to be additional tightening. So all this tightening may happen all at once. So the fear here is, well, if all this tightening happens at once, could there be a liquidity crunch? Could it send us, could it slow down the economy significantly? Now that's the worry. All right. So we shall see, we will see what happens to this. But that is the significance of this. All right. If people are still keep going, if this keeps going up, all right, that means short-term rates, won't, less of a ceiling. So it could still keep going up, which means it inverts the curve even more. Not only that, loans may get more expensive, and it could slow down the economy further. So basically, if you're a small business and you really rely on your revolving credit to keep your doors open, you're going to be in a world of hurt pretty soon. There's going to be a lot of small companies that have a lot of debt. They're going to start feeling, if they aren't feeling the pain already, they're going to start feeling pain very soon. Okay. And we'll see what happens. We'll keep monitoring this, and as this progresses, I'll report to you guys on what this does. But you can actually find it yourself. You can go to the New York Fed. You can also go to the St. Louis Federal Reserve, the FRED educational website, and they have this graph too. So you can monitor yourself. It's all free. The New York Fed and the St. Louis Federal Reserve has some great resources, great economic data that they offer to you for free. A lot of paid websites actually just get it straight from them. So it's, you can get it straight from the source. Although I think some of the data is a little bit delayed, but still, it's still good. It's still good data. All right. So that's kind of what's going on. Also, too, just big macro trends too. Either next week or at the end of the month, we're going to have some more crop data come up on corn and soy. This is something that I've been talking about for a while. We talked about this last week and the week before. I still think that this is still a possibility where we see even further spikes in the 10-year treasury because of food prices. And really, it's the weather here in the United States. the weather reports have been, very unfavorable, and so a lot of farmers have been holding off on planting grains. And so, I think at this point we are already past the point where planters decide which crop to plant. They can either plant, usually it's corn or soy, and we'll see in the report which one they chose. But if most of them went with soy, which as being the strongest grain, I can see planters going with soy. Also due to weather conditions as well too. You can plant soy a little bit later than corn. But if the amount of acreage and the amount of planters is significantly down, we could see food prices keep spiking up. And if food prices keep spiking up, if they can't control inflation, the Fed is going to get even more aggressive. So you can see what happened to the markets after the market changed its expectation from 2 rate hikes to 3. Well, what do you think is going to happen if they have to do 4 or 5 at a time? We could definitely see the VIX spike. We could definitely see equities come down. We could see the dollar go up. Let's see what the dollar is up to. I mean, the dollar has just been on a rampage. No prisoners. It's just breaking out. Boom, boom, boom. All right. Right here, I got stopped out of my long euro options contracts. I mean, it was a small position. I was really hoping for this to come down just a little bit more. If it had just come down just a little bit more, I would have doubled those options price. Those options probably would have doubled. And then I was thinking, oh, it'll come down and then resume. But it didn't happen. I tried to make money. Again, just like I said, like yesterday, with... And this goes back to just focusing on the big picture. Big picture is downtrend, right? This is equities, S&P 500. Downtrend, we were playing the counter trend rally, but we had data from here. We could plan ahead of time, right? And then the scraps, okay? This is where usually people get into trouble. You can lean on this trade going down with the major trend, okay? And maybe you can do a somewhat sizable position if you have the data to back your trade. But here, there was no edge. Small moves, peanuts, This was the meat and potatoes. This is like, the cookie crumbs at the kids' table, and this was small, I don't know, why participate in that? It's the same thing with the dollar and currencies. The main move is up. Trying to play this, that was stupid, really, in the end, in hindsight. We got to stick to the big picture here, okay? That's where all the money is. The money is made on the weekly moves, all right? Especially in this market. All right, so if the dollar keeps going up, I suspect that emerging markets will inevitably feel the pain. And it's already starting. It's already starting. You can actually see it in, if you read reports on what's happening in Sri Lanka. In Sri Lanka, they are already protesting, mass protests because of food prices going up, fuel prices going up. It negatively affects emerging markets more. Why? Because most of these commodities, the trades are denominated in dollars, and most also debt is denominated in dollars. So as the dollar keeps going up, all right, it becomes more expensive to service that debt. It becomes more expensive to get fuel, get food products, and that's just from the effects of the dollar. I mean, also just because of just market dynamics. I mean, oil is up too. So not only is the currency making it more expensive, but the actual commodity itself is also more expensive. So it's like a double whammy. All right. And again, the reason why I believe oil is still going up is because gasoline. It's really about gasoline. As long as that crack spread remains wide, there will always be a floor for oil. I kept saying it. The easy trade is to wait. Okay? waiting is also a trade. No trade is a trade. Okay, there is no edge in this right now. All right, there's no edge. You could go long, but if it it corrects and continues, I mean that drawdown, could be huge. Are you gonna hold that full drawdown? You could go a short here, but what if it spikes up? There's no edge. There's no way to really manage risk if you're wrong. All right. And again, as traders, our number one job is to protect our capital. Okay. If we don't have an edge, there's no trade. And again, the easy trade is to wait. I think around October, November, that's when we may see gasoline supplies go up. We wait for those gasoline supplies to go up. We wait for a breakdown in gasoline. And then we wait for the initial breakdown in crude. We wait for a back test, and that's when we short oil. That's the easy trade. And I think that's, you got to be patient. I think that's months away. Okay? That's months away. But we shall see. But anyway, in the meantime, EEM, emerging markets, will suffer. And it's already starting. Okay? It's not in the public eye yet. Okay, I'm pretty sure the Fed knows. I'm pretty sure Jerome Powell knows. I'm sure the Fed governors know, but it's not in the public eye yet. So I'm not trying to predict the future. I'm just anticipating the possibilities. I think this could go way lower, especially in 2023. But moves have been surprisingly really fast in this market. It's just getting faster and faster. So it may even happen sooner. And so I think it's very possible we see here 30s to 25s. I've already started legging in. Not much. Just a starter position for March 2023. I have the 39 puts. I only bought 2. Very little. That's not much. I'm still about 99% in cash. With this, I think I have this position. I have the Dow. I have the Dow. What do you call it? The leaps here. What other positions do I have? I think that's it. Is that the only positions I have? Yeah. Oh, and then the UVXY. The UVXY. The UVXY spreads. And all combined, I think it's like about 1% of what I have. Maybe a little bit over 1. So it's like 98, 99% I'm in cash. So that just tells you the scale. If you want to scale into something like this, if you want to follow along, that's something to think about. I don't have that much conviction yet. The timing is what's hard on this. What if after FOMC, what if we have a little bit of mini rally? Very possible. Definitely in the realm of possibilities. What if it goes straight down? Definitely within the realm of possibilities. So you don't know what you don't know. All right. There's no crystal ball to this. So we will see. There's going to be a big move after FOMC, but which way? Not sure. We shall see. Even if we do have an upward move, I don't think it's going to last long. It'll probably just if we look at the main S&P, even if we see a rally, even if we see a rally after FOMC, I don't see it really going past let's say 4,000. I don't really see it going past that. I think there's going to be fresh hedging demand once we get there. Okay. That's what we saw here on last week, right after it lost 4080, 4050. We just saw fresh hedging, lots of puts getting bought. And again, from before, when institutions buy puts, the market maker has to sell them a put. If the market maker is selling a put, that's a bullish position on their books. So they have to short the underlying to remain delta neutral. So that's what brings down the markets, fresh hedging. All right. So even if we do see a pop, I don't really see it lasting that long. But we shall see. If it pops, I start building way more put walls. I like IWM and EEM. I'm not doing spreads. Some of you may be asking yourself, well, Dan, you've been, you've been saying for days on end that you're doing put walls. Why are you doing just puts here? Well, the thing is, right now the current IV percentile is quite low on EEM. It's not like the other indexes right now. The other indexes, the current IV percentiles are a lot higher. A lot higher. That's why. Surprisingly, the longer dated puts, especially close to the money, are cheap on EEM. Comparatively cheap-ish. Okay. Oh wow. Somebody just bought 1,940 puts just right now. I didn't see this. This was zero. It just happened within probably the last 20, 30 minutes. So somebody's adding on. I know that here, this was quite recent too. No, actually, I don't think so. I don't think this was recent. I think this was a while back. But it just happened now, I think. We shall see. We'll see what happens. Okay? If we see a pop, I'm going to scale more in. Probably by the end of it all, I want to see myself having about 50 of these. 50 to 100 of these. Again, that's the scale. So I'm literally just like 1 to 2% of the position that I want to have, or up to 4% of what I want to have. So we will see. We'll see what happens. We'll see what happens with this. Okay. UVXY. Let's see what's going on with UVXY. We are in backwardation. Okay. So there is tailwind for UVXY. Still got the position. I'm expecting, I really want a full payout from this, the full $5, the difference of the spread. And I think that's going to happen if we get into the 30s. I have until December. So we shall see. My other position, Dow, not doing very well. Again, very small position. Right here. Very small position. I was gonna buy 1,000 shares of Dow, but when I saw this, I said if I hits this red line, I'm gonna buy 1,000 shares. But then when I saw it gap down like this, I got scared. I couldn't buy the 1,000 shares. I was too scared to buy the shares. But my thinking was, well, what if my fear, because of my fear, I miss out? What if it goes up? That's why I bought those cheap low delta leaps, for about 75 cents. I bought 10 of them, which, 10 is for every 100 shares. That's, that covers 1,000 shares. So I figured I miss out on one dividend payment, I'll buy these shares later when conditions stabilize. So I'm willing to give up one dividend payment just in case if I was wrong about this continuing down. But it continued down. I'm so glad I didn't buy those shares. Those shares, 1,000 shares, I'd be down like $3,000 on that position. But I think on my 10 leaps, I'm down like $150 off of that. That is, psychologically way less taxing than, a $3,000 loss on 1,000 shares. We shall see what happens. And, that I have about a year and a half. So even if it goes against me, if everything turns up at the end of the year, I could still profit off of those leaps. So I'll probably hold on to them. Zero or hero. It's like a lotto. All right. For some of you, you asked me, if a lotto is right for you or not. I've been getting some DMs about, position sizing after yesterday's video. let me just put it this way: those low delta leap plays are very low probability, but when they do hit, I mean, you can get like 8 to 10x payout, 800 to 1,000%, or even more. One of the biggest low delta leaps I ever did was back in 2020 on indexes. I made 16x, so 1,600% on some of these QQQ leaps. So definitely it's possible, but they're very low probability trades. I know some of you've got smaller accounts. If you've got less than $5,000, you probably shouldn't even do this. Okay. If you've got a $10,000 account, maybe you can buy one leap. The reason why is if you have less than $5,000 and you pay for one leap, which is $75, that's like 1.5% of your portfolio. I think that's too much on a low probability trade. That's just the scaling that just for your reference. When I do trades like this, like low probability lottos, whenever I say lotto time, that's what I'm doing. I'm putting extremely low percentages of my speculative account into this, and my spec account is all from selling covered calls and premium on my core holdings. So it's like quote unquote free money. It's like house money anyway. And out of that, I take extremely small percentages. All right. Like 0.1, 0.5% of that to play these lottos. I don't put any much into it. Now, other trades like those put walls that I built back in late March, early April, I leaned into that. I put like 50% of my spec account into something like that. Those are higher probability trades, and those, I had 3 to 6 months on a spread. Those I will lean on. Here, I put about probably risked about 5 to 10% of my spec account for this counter trend. Of course, the data came in here. That's the only reason why I even did 5 to 10%. If I didn't have that strong of a data, I probably would have done less, maybe like 1 to 3% at risk. And then these lottos I did here, less than 1% each. Some of them even less than 0.5% each. Okay, that's the scaling. So if you've only got a $5,000 account, to even buy one contract of that low delta leap, I think it's too much. You really need to save your money for those high probability trades and lean into those, in my opinion. Okay. I'm not your financial advisor. I just post my plan, and it's up to you whether or not you want to follow. But just food for thought. If I had only $10,000, maybe I would do one. Honestly, though, these kind of low delta, like low probability trades, you probably shouldn't be doing this until you have over 6 figures in your account. But that's just me. Some people will say, no, you should be doing it. You can do it earlier. But in my opinion, I think if you don't have 6 figures, probably shouldn't be doing these low delta leap lottos. Probably shouldn't be doing much lottos, period, if you've got less than 6 figures. I know for some of you that's not what you want to hear, but that's just my opinion. Okay. Let's see what's going on in other markets. Gold. I posted something about gold a few nights ago. I was trying to get filled. Thank goodness I didn't get filled. I was thinking about buying some spreads, call spreads here. I would never do a leveraged futures long. That's like undefined risk, especially in a choppy market like this. Overnight, I was trying to get filled on some spreads. It didn't happen. And then volume started drying up, so I just canceled the order. Thank goodness. With that huge yield spike that happened, we saw gold just tumble. So until I see some type of confirmation, I'm not going to enter any gold trades. Let's see what's happening with AUD USD. We've been talking about China. Remember I said if it breaks this, that's a lie detector. That means that the recent move in China is a fake move. It's probably some short covering. Well, guess what? Broke down. Today's a little bit of short covering day internationally. Most Chinese stocks obviously are closed, especially the ones that are over there. And there's some Chinese stocks, that have ADRs here, but most of these track the stocks in overseas. So there was a little bit of a short covering day in international markets. But yeah, see, it broke down after AOD gave us that kind of that signal that this was a fake move, that it's probably not going to last. So, data, it works. Let's see what else is going on. I know we looked at the grains, except wheat. We didn't take a look at wheat yet. So still within its range. What's going on with meat prices? Meat prices still in an uptrend. Still in an uptrend. Really though, we're going to be looking at this for the next couple of weeks. And I think if this spikes and food prices spike, watch out. This is just going to keep on going up. We might get into the fours. That's, in the beginning of the year, if you had told me that 4% 10-year was a possibility, I would have been like, probably not. That it doesn't look like it now, does it? It looks like definitely it's within reach. Definitely within reach. And if that's the case, again, the buy, the dip, the valuation level is going to be here. Okay. If we see interest rates go even further, if interest rates go even further up, we could go here. I don't think so. I think if it's around 4, I think it's, it probably will stabilize. And if that's the case, I think we go here. Again, I'm not trying to predict the future. I'm just anticipating what could be and just trying to think 5 or 6 moves ahead. But we shall see. All right. There's going to be a lot of data that comes out. So we'll figure it out together. But definitely, this is what I'm looking for. So hopefully we get a little bit of pop, though. I would love to see a little bit of rally so that I can buy some more puts and just ride this thing down. And again, I'm going to use IWM primarily, maybe some QQQ. Again, after the rally, we will see. We will see if IV kind of decreases. And of course, EEM, I think is really going to suffer. Again, really, it's the most important charts right now is dollar and the 10-year treasury yield. That's what every professional is fixated on right now, is this. If you go to Bloomberg Terminal, most of the conversations amongst the pros is about the dollar and the 10-year. If you go on the floor of the New York Stock Exchange, they have all the indexes plus this. Very important. All right. So that's what I'm seeing. Any questions? I see people typing. Go ahead and type on the voice chat text if you've had any questions. See what's happening with some other indexes while you guys type. Oof. What's the Dow doing? Oh, the Dow is underperforming the S&P 500. Probably some dividend payout ratio corrections going on. Yeah, definitely. Dividends too low and too high of a dividend payout ratio. Investors are worried that that dividend is not secure. We talked about this last week. We anticipated this. It's coming true. It's coming true. But what I didn't anticipate was that Dow Chemical was going to get hurt because their dividend payout ratio is quite low, and their dividend payout is higher than the treasury. It's at like 4.7 now with the decline. I would have thought companies like this would have been saved, but no, I don't think the market really cares right now. It really doesn't. I don't think. We shall see. What EEM level am I looking at? EEM levels. So as I said, I bought close to the money. I bought the 39s for March 2023. I think we could definitely go down into the 30s. And if we overshoot, it, maybe into here. I mean, I looked through the EEM components, and there's about 20% of it that's quality. And then the rest of it is just, excuse my language, but the rest of it is dog shit. All right. And especially also too, a lot of the Russian stocks got out of EEM, and I think they just filled it with whatever. I don't know how much due diligence they put, and I don't know, what the methodology was to add all those other companies. But I looked through some of them. I looked through some pages of some stocks. I even looked through some international exchanges. I mean, some of them are just, there's some low quality stocks in there right now. Right now, like I said, Sri Lanka, it's already starting. We're going to start probably seeing this spread to Latin America, Turkey, Greece, Southeast Asia, like Thailand. It's not in the public eye yet. It usually happens very quietly, a few select areas, and then all of a sudden happens all at once. All right. And that's when we get these, huge drawdowns in EEM, huge drawdowns, a little bit at a time, and then all at once. Here too, a little bit, and then all at once. I think so. Again, we might see a pop, so that's why I kept it very small. And if we see a pop, that's when I can lean into that trade. All right. And I'm going to use that as part of my hedges, but most of my hedges are going to be put spreads on IWM or QQQ. And then I'll round it out with some of this just for a little extra alpha. Okay. I'm trying to figure out where this pump from Tesla is coming from. Yeah, it's just, right now, it's just a little bit of short covering, I think. I mean, it already got dumped. The short covering got dumped. And I think that dump was probably those margin calls. All those longs getting closed out. This is day 3. Friday, Monday, Tuesday. This is day 3. So maybe we might even see more dumping at the end of day because of that. A lot of brokers do it at the end of day. A lot of their margin call liquidations happen at the end of the day, last hour. So we shall see. We shall see. Tesla, yeah, I think, what is it? Elon was on the news. I think he's having a little town hall meeting with Twitter employees. And that's why it's causing a little bit of pop in Twitter. I don't know why. I don't know why that is such a thing. Oh, somebody's talking. Go ahead.
Yeah, I'm the one that asked the question. Really what I did was last week I saw the downtrend. We've had about a week and a half of a downtrend on Tesla. And so what I did was I bought it on a little pop around 680 or so. And I bought time. I bought this Friday after FOMC. I just, and I've been riding them down. I've got a few runners left, but I'm just watching it, like kind of curious, like what would pull this stock up like this, knowing that the market is just flatlined. I mean, SPY is slowly on a downtrend for the day, and something like this is just holding up. I really truly believe that we see 600 this week on Tesla, just based on what I can see by old fibs and things like that. But I was curious what you thought, man.
Yeah, I think this is just a little bit of short covering. Um, and especially since this is a major component. Let's see if hold on. Yeah, ARC is up too. I can definitely see this being just short covering, maybe for ARC, just for liquidity sensitive areas. A lot of people, the every right now the people know now. All right, that this problem is going to last a lot longer than expected. And we are going to see some severe liquidity crunches. Okay, and so what's the most liquidity sensitive areas? It's tech, small cap. Tech and small cap. Okay, they're the most sensitive to liquidity. And so when this happens, I can see a lot of speculators piling into shorts. All right, and now there's just a little bit of short covering. A little bit of short covering, risk getting off the table for FOMC. Okay, we see ARC up. That's why I think Tesla's up. Just a little bit of short covering. I don't think I don't think this means much. Really, it really doesn't mean much. I mean, yeah. See, Triple Q is the one that's outperforming all the other indexes. All right. I think it's just this was the most liquidity sensitive. So when people bought puts to hedge, and people shorted with leverage, they probably shorted this. Again, just a little bit of short covering. IWM. Well, IWM though, it's just so bad. I mean, the situation is going to be really bad. Interest rates are going to go up. That reverse repo facility with more of it being used, and it's still increasing. That is not good news for small companies, because that means bank deposits are going to go low. And when bank deposits go low, banks have to compete for deposits. And when banks compete for deposits, they have to raise interest rates on loans. Okay? And small caps heavily rely on debt. I mean, there's a lot of zombie companies within the Russell 2000. Lots of zombie companies. They don't produce anything. They don't make any money. No revenue. No nothing. Okay? All they are is just debt. Just debt. Revolving credit. They will have to get washed out before this is all over. Okay? So I think it's just it's just a little short covering. That's it. Yes, Nunya, we are still recording.
What were the prices that you were looking at?
For which one?
They have are they just very high premiums? Can you pull up the options chain real quick?
For which options chain are you talking about?
IWM specifically.
Okay. Right now, again, the current IV percentile is so high. That's why it's so hard for me to even leg into this, even with one spread, which is nothing. It's like, even putting like 0.1% or 0.5% of my portfolio into this when current IV percentile is so high, I just can't. That's just too high. That's Tesla, but IWM, same thing. It's still high, 57%, 89. Woof, that's crazy for an index. That's crazy, but 57, that's pretty high. And so that's why you would have to go down the chain further, or you would have to go a little bit closer to expiration. I mean, right now, let's say I think the 150s, let's say 150, 145 put, it's $1. That's 4 to 1. What is that? 15%? What to 145? That's what? 25? So yeah, that's like 15%. I guess that's not bad, but that only gives you 3 months. I would like to get 6 months. Yeah, I mean, yeah, gamma may not work toward my favor, but I just like having a little bit more time, just in case, just in case if I'm wrong, if it pops or if it's a choppy way down, then I'm not shaken out as much. It helps with my psychology, So yeah, I would rather see some higher prices before I get into this. But that means I might miss out, which is okay. I'd rather miss out than just be wrong, and then be wrong by a lot and have this IV, work against me. That's what losers do. Losers only think about the potential payout. For me, the number one thing I think about is, what's my loss? What if I'm wrong? What if I'm dead wrong? And then I work from there. And if I'm not willing to accept me being dead wrong on it, then I just won't enter. All right. Risk management. Again, our number one job as traders is to preserve capital. Okay. We get paid to manage risk. Always remember that. That's what you always need to think to last in this business. It's a marathon. It's not a sprint. All right. Let's just take a look at, I'm just curious. Let's just look at November. Ideally, I want something like November. But, I mean, is it going to give me even anything favorable here? 117. Okay. 117, that's not bad. That's like, what? That's like 3-1. A little bit better than 3-1 reward to risk. I'm just curious. What is 150 right now? Delta 26. There's a little bit low delta. I like to be on the long contract. I like to be at least delta 35, 30 to 35. Delta 30 to 35 on the long contract, and then I want at least 3-1 reward to risk, minimum 3-1. I'm not doing anything less than 3-1, especially for a hedge like this. Yeah. 155. Yeah.
Question
Yes.
particularly for that trade.
Yes.
When you're buying the option and making the spread, are you selling like using the other option as collateral, or you need to have the cash equivalent available?
This one, all you need. So let's say I were to buy this spread, the 155 long, 155 short, 150. That's if you just buy one spread, you're just paying the debit. It's defined risk, so you only pay the debit. So it's $135 per spread. Again, you're not doing this to take assignment. Yeah, you are short a put at on this example, 155, 150. But the thing is, let's say it blows past that short strike. Well, that's okay. And if you hold it to expiration, which I don't see why you would, you don't want to hold this to expiration. But let's say you did and you got assigned on the put. If you're short a put, you're obligated to buy at 150. Well, then you can just exercise your 155, your right to sell. So you sell at 155, you buy at 150, boom, you still get full profit. You still get your $5 per spread, and you paid 136 for it. So you're not doing this for assignment. And again, the brokers know this, so they're not going to ask you to put collateral up for it because you have this long 155. Now, if you were to sell that long 155 and only leave a short 150, then yeah, they're going to demand that collateral from you as you sell that 155. But as long as you keep the spread, no. All you need to do is pay the debit, the 135.
Then how would you close that?
Just sell it all at once. And so let's say this doubles to, let's say, 270. Boom, you sell it and you get your 270. So this is a buy, and then this is a sell. So let's say IWM goes down, sell it for 270. Ideally, I want 4. So, $1.25 or $1.25 to 4. Ideally, this round I said I wanted to buy something less than $1 so I can get 4-1. But seeing as where we are, I think I might have to settle for $1 to $1.25, 3-1 reward to risk. I may have to accept that. So if that's the case, yeah, I definitely want to get to 4. But again, if we see an exhaustion signal or if we see a big reversal, if the data says that the sell-off is over, then yeah, we take our profits and we move on. We take it day by day. But right now I'm just anticipating, just thinking 3 or 4 steps ahead. That's all. Hope that answers your question.
Yep. Thank you.
All right. Do you like the spread now? No, I'm gonna wait. This one I'm gonna wait. Again, the reason why I'm gonna wait because the IV percentile is high. Anything over 50, I think, is high, especially in the indexes. And again, with EEM, it was low. It's under 30. So that's why I was willing to dip my toe. And again, very small position. I'm still like 98, 99% in cash in my spec account. Even with all of this positions, the UVXY, the Dow, and this, all combined, it's like 98% cash. Again, I'm going to try to do like 500 spreads between, well, the plan was to have about 500 spreads between UVXY, IWM, QQQ. Most likely what I'm going to do is maybe do maybe 200 each, IWM and QQQ. Again, depends on IV, depends on how much we get on a rally, if we get a rally. And then maybe I get like, I don't know, maybe a 50 of these, 50 to 100 of these, maybe 50 of these or so. That's my hedging plan so far. So again, if I'm trying to buy 50, I just got 2, that just tells you kind of the scale and how much faith I have in it now. I'm not going to lean into something like this now when there's so much uncertainty on the eve of FOMC. I'm just not going to do that. Holding cash is a position. All right. So, I hope that answers your question. All right. Okay, so it seems like there's some questions after we get off recording. So unless there's some questions now, if I see some typing on voice chat text, I'll answer them. Going once, going twice. Okay, I'll put some. I'll put the recordings out by end of day. And let's see what happens tomorrow at FOMC. Same time, we'll have the high noon highlights, noon Eastern time. Let's get this cheddar together, all right? Have a good day, guys. Trade safe.